Welcome back to Zodiac Trading. So in this YouTube channel, we talked about trading, politics, and we talk about investing and etc. So today we'll be covering about very interesting topic, which would be related to uh, bond crisis, which I think will happen in the near future, similar to what happened during 1998, the LTCM crisis event, which is a very famous, I would just say, systemic risk event in the financial universe. If you go to any universities, if you are studying finance, you study, I don't know, whatsoever, maybe financial mathematics and uh, fancy investing and concepts, etc. Your textbook would probably cover about long-term capital management, and most refer as the LTCM crisis. So today I'm going to talk about LTCM crisis because this is a case that tells you, uh, that shows to every students in the world of finance the nature of finance and how simple failure will become a catastrophe and also becoming a disaster. And sometimes these is that disasters will cause chain of events. And I think in this case, long-term capital management provides a perfect outlook for the future bond crisis and liquidity crisis. Okay, so we'll be covering several things. We'll be covering, first of all, timeline of long-term capital management crisis. I'll be talking about the reason and the cause and effect of long-term capital management. At the end, we will cover a little bit of my points on the near and upcoming bond crisis and what might gonna happen. So it will be I would say it would be a warning signal to global investors. So let's first look at the long-term capital management. So long-term capital management was a legendary hedge fund which was founded by John Meriwether, and this guy is a legendary bond trader. He started his career in Solomon Brothers, and he was one of the top gun in the Wall Street. And he decided he wanted to start his own hedge funds, and he's grouping a lot of Nobel Prize winner. And it sounds really fancy because imagine back in 1994, a legendary fund manager decided that he will leave Solomon Brothers, which was one of the best bond trading firm in Wall Street, and he decided to partner with a bunch of genius and start a even bigger hedge fund. And what will be the results? Of course, investors will be pulling their money. You know, we're talking about family offices, we're talking about uh, authentic, really, really wealthy individuals. We're talking about fund managers, and also we're talking about sovereign fund managers. We're talking about trust managers. We're talking about retirement fund, whatever managers they would try to give money to this guy Meriwether. So to let Meriwether to continues to make money for these funds. So they started to trade on different bond trading strategies. So it all sounded really fancy back then, because they invented a term such as convergence trade. That term is to use as when the bond price fluctuates, when sometimes bond prices are going to another direction and sometimes you go back and you are trying to correct that price. You're always trying to arbitrage. So you arbitrage when the bond price is too high, you short it when it's too high, and you long it when it's too, you kind of long it when the bond is undervalued. So it was a very simple strategy, but it sounds really fancy. So they started to, uh, had really good results because they were adding leverage on simple trading strategies. They had tremendous portfolio trading, convergence trade, and also uh, the the bond basis trade. That means the bond traders are basically correcting the bond prices on basis point, that you are making small amount of profit, but you are making a consistent amount of profit, and the probability of that strategy is pretty high. But once things go bad, because you had a large leverage, you will tend to lose very big. So that's the nature of the trading strategy. So if you are interested in becoming a trader or become an asset manager in the future, you realize one thing. If things are certain, you make small profit but lose big. If things are very uncertain, the probability tends to be small, but the outcome, the return, once you are right, will be huge. And that is the nature of the financial assets and financial events. So what happened is, they were having huge success, and then until up to 1997, they encounter the Russian bond crisis. They had good results in 3 years, so investors believed them. And long-term capital management's the size of their AUM was just keep growing and growing and growing, and until it's really big, and until that long-term capital management basically become one of the biggest one single participant in the bond market. So what happened in 1997 is, I don't know what happened with this Meriwether guy, but he believes, because Russian back then was the Soviet Union resolved, and Russia claimed that they are going to have a democracy system. So a bunch of fund managers, from Western world, they think there might be a bright future for Russians. So they decided to long a lot of Russian bonds when the price is cheap. So what happened is, of course, Russians gonna default, and they counter a bunch of debacles in 1998. So in May, the portfolio lost 6%. June, they have losses of 10% because part of it because of the Russian bonds, and part of it because the huge volatility of the bond markets. So because, as I have told you before, the bond trade basis strategies have these huge downside. When you have large volatility, the strategy becomes really unreliable. So in July, the portfolio have a decline of 18%. August, stock market plunge. Long-term capital management lost $553 million because they were basically maintaining a neutral position. As you know, if you are trading options, then you know things when huge volatility explode, there will be a huge upward or maybe downward trend. So you, as a bond trader, as a neutral strategy fund manager, that would be your worst nightmare, because you're not taking sides. You don't want the market taking sides, but then the market has this extreme environment and you lose all the money. So to end of August, the long-term capital management fund lost 44% of its value. In September, long-term capital management performance goes into free fall, and then that goes down more than 83%. And so what really destroyed long-term capital management is actually their huge position. They are having these huge and concentrated bets, betting on Russia bonds is going to thrive. But then what happened is, the Russia actually claimed defaults on its government bonds. So that was in 1998 in August. That was the biggest hit to long-term capital management because they had huge position in Russian bonds. With Russia defaults with its government bonds, that basically means what they are buying are actually worthless. So they're taking great hit and they are bankrupting. Okay, so what happened is because they are huge, they are large scale fund, and they're basically absorbing all the liquidity in the bond markets. So now they become the biggest elephant in the room. So what happened next is the Federal Reserve have to aid them to try to give liquidity help. Otherwise, the bond market will collapse with long-term capital management. So in 1998, September 23, Warren Buffett offers to buy long-term capital management for $250 million and to recapitalize with $4 billion from Berkshire Hathaway, which was a tremendous amount of money. Think about that was long time ago, and you have such amount of money in the market. So then the offer was refused. Like a lot of because Buffett was giving long-term capital money management only a few hours to decide, and then they just declined. So it's very similar to what happened with Lehman Brothers, because if you found this company and then someday you want to sell this company very cheap, and it's going to have problem. 1998, and I don't think you were willing to do that. So naturally, he declined the order, refused the offer. So in 1998, 100 lawyers meet. They represent a consortium of 14 banks. So they're trying to understand long-term capital management's balance sheet and how they could try to help resolve its problem. And up to September 28, long-term capital management equity capital falls from $2.3 billion to $400 million. And then that was a tremendous free fall, because think about long-term capital management, because you have huge position and then you cannot sell your position because no one's going to take it. There is not a single one counterparty in the bond market is capable of taking their bets. That is the most I would just say challenging situation that was ever faced, because long-term capital management was, in order to enlarge the return, they were using having leverage. So basically that means they're borrowing lots of money, and now they have loads of bonds, loads of equities that they cannot sell. So their leverage ratio was even more than 250 to 1. So that means you're borrowing 250 times of your own capital to generate that insane amount of money for your investors. So it turns out all the genius adds up. They're just using very boring strategy. They just use with an excessive amount of leverage. I mean, as if you're a retail trader, and you'll probably be doing a lot better than long-term capital management. At least you won't be using 250 to 1 ratio, leverage ratio in your own portfolio, right? And then December 1999, under the consortium leadership, it winds down its position in December. And then it has a huge and painful restructure. And then the Federal Reserve have to step in and to really kind of clean the mess. That was the one of the few and first bond liquidity crisis, because a lot of rates traders, bond traders, they are making boring strategies. Their main strategies like convergence trades and trading bases. You're trying to make money out of certainty. But financial market in nature has lots of uncertainty events. For example, Brexit. It has inflation. Sometimes you have COVID-19, and then all these uncertainty. They're going to destroy your neutral strategy at any time. So Right now, as I see in the bond market, you will see a lots of traders, rate traders, trying to sell treasury notes because the bond markets, because they think that the Federal Reserve is going to end its rate hiking cycle, and they think it is the end of this cycle. Therefore, they are going to short these treasury notes. So then you're going to have another big headache because you're going to have a similar repo crisis. You're going to have a big problem like LTCM. Probably not at that level, but in 2020 and 2019, we were seeing the very similar situation. We were seeing the entire bond market liquidity was dried, and it just yeah, it hardly ever has any kind of trading volume back in the day. So bond traders are having like huge headache, and hedge funds were suffering huge losses, and the Federal Reserve would have to inject billions of dollars to kind of revive that liquidity in the bond market sector. So I think in near future, probably gonna see this by the end of this year, that we're going to see another huge repo crisis. We're going to see, people crowded making these neutral bets like LTCM. Certainly, the market has a huge volatility, and that just totally, destroy all their neutral position. And I think, especially for lots of bond traders, they're going to have huge problem with their trading strategies. So if you're lucky to become one of the audience of this channel, I think it is your time, it's your term to make certain adjustments and possibly hedge yourself against the upcoming bond crisis and bond liquidity crisis. Okay, so that's all for today's episode. Thank you guys for watching. And if you like to share or comment anything, please uh, comment it in the section below. And I will try to respond as much as I can. And please subscribe and press that like button for me. I'll see you in the next episode. Bye.